Many thanks indeed for joining us here on Business News. Here are some of the stories we are tracking for you at this time. The debt management officers decried Nigeria's growing debt profile, blaming it on low revenue generation and remittances, as well as annual deficit budget by the federal government. According to the Director General of the DMO, Ms. Patience Oniha, the country has been indebted to the tune of 41.6 trillion naira as of March 2022, pointing out that borrowing will continue until the government addresses issues concerning the personnel, overhead and capital costs of the ministries, departments and agencies, MDAs. Now, speaking during a presentation to the House of Representatives Committee on Finance of the hearing of the proposed 2023-2025 medium-term expenditure framework and fiscal strategy paper, Ms. Oniha noted that as at December 2020, the debt stock of Nigeria, which includes the federal, state government and the Federal Capital Territory, was pegged at 32.92 trillion naira, but by December 2021, the country's debt stocks increased to 39.556 trillion naira. And now the total value of capital importation into the country declined by 2.40% to $1.54 billion in the second quarter of the year. Well, that's according to the latest reports from the National Bureau of Statistics. The NBS in its foreign trade data disclosed that in the corresponding quarter of 2021, capital importation into the country recorded an increase of 75.34%, amounting to $1.57 billion. The report also shows that Lagos topped the destination for foreign capital inflows with $1.05 billion, accounting for 68.66% of total inflows into the country, closely followed by the nation's capital, Abuja, with a trade value of $453.95 million. Anambra State attracted $24.71 million, Kogi $2 million, and Ekiti State $40.50 million during the quarter. However, portfolio investment accounted for $757.32 million, representing the largest capital importation in the period under review. Amid rising interest rates, combined debts by manufacturers in the country from commercial banks in the country rose to 4.54 trillion naira in June 2022. According to latest reports from the Central Bank of Nigeria, operators in the nation's manufacturing sector borrowed the sum of 450 billion naira between December 2021 and June 2022. With the increase in debt, stakeholders in the manufacturing sector have maintained that the current double-digit lending rate is unfavorable, as it has a direct impact on the cost of production and the competitiveness of the sector. Meanwhile, Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, noted that crippling inflation, worsening purchasing power, and the attendant effects on the economy appear to have forced the CBN to effect policy changes for the stability of the Nigerian economy. Now, with total spending on the controversial petrol subsidy now exceeding oil revenue, the Nigerian National Petroleum Company Limited outstanding debt on what in terms under recovery hit 1.044 trillion naira in July this year. Well, according to recently released data from the National Oil Company, the firm also deducted 448.7 billion naira for the purpose, a record high since the re-emergence of subsidy payment early last year. Furthermore, a tie-back to June showed that the overall NNPCL crude oil lifting for the sixth month in terms of export and domestic was 7.27 million barrels, a decrease of 18.68% relative to 8.94 million barrels lifted in May. This implies that the amount spent on petrol subsidy for the month exceeded the total oil sold for the month by roughly 48 billion naira. On the international scene now, September kicked off on a stormy note as persistent worries about rising global interest rates and recessions hounded stocks, bonds and oil prices, and vaulted the US dollar to a 24-year high against the yen. After dropping over 1% earlier in the day, US stocks reversed by the end of the session to eke out modest gains, with S&P 500 index recording 0.3% increase. The Dow Jones Industrial Average rose 0.5%, while the Nasdaq Composite finished down 0.3%. Europe's stocks share index of 600 companies slid 1.8%, and MSCI's broadest index outside of Japan index lost 0.8% to stand at its lowest since mid-July. Meanwhile, Asian stocks slid overnight as investors sold everything risky that was not nailed down. Japan's Nikkei skidded 1.5% and Hong Kong's Hang Seng Index fell 1.8%, while China's blue chips CSI 300 ended down 0.9%, having been anchored earlier in the session by hopes for more economic stimulus from Beijing. And the U.S. Federal Reserve has terminated a decade-long enforcement action against HSBC Holdings plc, under which Europe's biggest bank by assets was ordered to improve practices after violating money laundering and sanction rules. The termination removes potential regulatory overhang for HSBC, which has been trying to shrink its presence in some North American markets, where it has struggled against competition from larger domestic players. In May last year, the bank announced it was withdrawing from U.S. mass market retail banking by selling some parts of its money-losing business and winding down others in a long-awaited move as the lenders stepped up a shift in focus to Asia. Meanwhile, the Bank of Canada is expected to pull off a coveted soft landing, bringing soaring inflation back to near its 2% target without tipping the nation's economy into a major downturn. According to reports, the inflation forecast is projected to fall sharply to near target by the end of 2024 from about 8% currently. Meanwhile, economic outlook shows that once inflation begins to abate, the central bank will fine-tune rates back to more neutral settings below 3% without a sharp reversal in policy. And to wrap things off on business news at this time, oil prices on the international market surged today on expectations that OPEC Plus will discuss output cuts at a meeting on September 5, though concerns over China's COVID-19 curbs and weakness in the global economy continue to limit gains. U.S. West Texas Intermediate crude recorded a price surge of 2.94% to hit $89.16 per barrel. Brent crude now sells at $95.02 per barrel, registering an upward price margin of 2.88%. The Bonnie Light's trading value is at the red zone, selling at $94.93 per barrel with a price decline of 3.59%. For the OPEC basket, the crude oil trade value is at $101 per barrel with a price dip of 5.05%.